This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 79. Foreign ownership. Good or bad?
Today on the Debunking Economics podcast with Professor Steve Keen, a topic that keeps talkback radio phone lines running hot. When they're not talking about too many foreigners coming into the country, it's foreigners buying too much of our land or too many of our companies. So today we ask, foreign ownership, is it a good thing or a bad thing? That's today on the Debunking Economics podcast. Yes, hello, I'm Phil Dobbie. Now, foreign ownership is a contentious issue. We blame foreign-owned companies when they downgrade or pull out of a country. And we don't like foreigners owning land because we fear food security is going to be compromised, whatever that means. I mean, if World War III strikes, I would have thought we'd still be able to access the food in our fields, even if it's owned by foreign companies, wouldn't you? I don't think we'll really care too much about who owns the field. So are we right to be worried about foreign ownership? Foreign companies or individuals own land, farms in other words, or mining land, and they own houses and businesses. Is any of that a problem? I wonder how much of this is overblown. Well, Steve, I mean, in Australia, is it overblown? Because 14% of agricultural land is in foreign ownership. Now, that doesn't sound like a lot to me.
14% is pretty substantial, actually. And if you think about how does it relate to the productivity of the other sections that are under ownership, it depends upon, and a lot of that ownership is the enormous, maybe people's vision and ideas, it's truly enormous land devoted to cattle farming in the north of the country. So there are some farms in the north of the country that are bigger than Belgium, so which are foreign owned. And you would expect those to be the higher productivity levels than some of the more small scale dairy farming and things of that nature that tend to remain in local ownership. But I've got an ambivalent feeling towards it because it depends on to what extent is this a case of vive la différence, and you have a different approach to capitalism having an impact on your local society in ways which can both be beneficial because new ways of doing things are brought in. Because you can always see in that sense the movement of Amazon into a different country, as is also happening in Australia right now, as a sign of that. And that's a technology which no local, the Amazon marketplace is a technology that no Australian company has developed any particular variant of. Therefore, you've got a new form of commerce for the society.
Right. So you're saying that's a good thing. I mean, to use the Australian vernacular, it's like a kick up the arse for the retail industry, isn't it?
Which it needs, yeah. So in that case, you can say, all right, it's good to have these foreign ideas coming in because they are ideas that were not developed domestically and they are worth experiencing. Equally, of course, there'll be Tesla vehicles turning up in the country. Yeah,
but that's a different proposition to owning land, isn't it? So you have this argument that we are literally in Australia selling the farm. In other words, here's land that we're using to produce goods which we're selling to ourselves or selling overseas. Yeah. Why would we sell that land to foreign owners who reap the benefits of it and also repatriate the profits back overseas?
Well, this comes back to the question of whether it's a positive development because you're getting some new ideas coming in, or it's a negative one because your own economy is unsustainable in various ways, and you end up having to sell off the crown jewels to finance your activities. And that's the area where I think I've got my critical attitude towards things like land being sold, because the classic balance situation for the globe is the sum of all trade surpluses is zero until such time as you start trading with any Elon Musk outputs on Mars. The balance of trade for the entire planet is zero. If you're running a trade deficit and persistently doing it, then there is a need. You have to balance that loss in the current account by generating money to buy the goods you're buying from overseas on the capital account. Right. And that, that's putting it in a rather jargonistic way. But if you run say $1 billion deficit in 1 year, what that means is that if you had stocks of foreign money, stocks of Australian dollars American dollars, let's take a British example now, stocks of American dollars at the Bank of England, and your local consumers were persistently buying more American goods than they were buying British goods, then to actually pay for those American goods, you've got to either use what you've got in reserve. If you don't have enough in reserve, then you have to sell various assets domestically to raise American dollars.
But these are private companies, obviously, with farms. These are private individuals who are selling the farms, and I guess they've probably got mixed feelings as well, because they're getting a better price. If you open the universe from domestic buyers to global buyers, obviously you're going to push the price up. You're going to get more for your land.
Again, that's a quote taking it out of context in some ways, because has the economy been growing so slowly that you've been running yourself slowly into the ground, and therefore the capacity for local buyers to pay a decent price is not because they're being stingy compared to the foreigners, it's because they simply aren't generating enough income flow themselves to be able to purchase those domestically generated assets. And it's more that case that applies in countries like the UK, where it's losing land overseas, and certainly Australia, which has been running trade deficits of the order of 5% of GDP for virtually 40 or 50 years.
But it's interesting. It's interesting you mentioned the UK, because you know who the biggest landholder in Australia is? It's not China. It is the UK.
The UK, is it?
Sure. Yeah. I mean, it's pretty close. I mean, China's about to take over. But yeah, certainly the biggest landholder at the moment. So there we are. But I mean, on the balance of trade question, I mean, you're on a hiding to nothing, aren't you? Because I mean, you ultimately you make the balance of trade worse. So I mean, because you're producing goods, and a foreign owner might get more out of that land or more out of that factory and might be more productive, but also because they're taking a slug of that money back overseas, that's not helping your balance of trade situation.
Well, fundamentally, what you've handed over is your capitalists are now foreign, your workers are domestic.
Yeah.
And it's the extent to which your local market encourages those capitalists to invest domestically as to how much of those profits are retained inside the country and used to develop your industrial base or your corporate base in the host country. But this is the classic story of multinational corporations, and when it's amplified by countries running persistent trade deficits, and of course these things are all supposed to be eliminated by floating exchange rates something like 30 or 40 years ago. Well, so much for that story. We've still got persistent trade balances around the world. And what happens in that case, the countries running the deficits ultimately are ceding their capitalist class to a foreign capitalist class because, as you say, over time the ownership of resources falls into foreign hands, and you don't really have any domestic capitalists anymore. Not, you don't have none, obviously, but you have a decline in the extent to which there are local capitalists who are potentially likely to invest locally. So it's the slow growth of the economy because it's being less successful industrial policies, less successful exchange rate policies, as John Mills emphasises, means that over time you actually end up having to sell your assets. Your assets are owned by the capitalists rather than the workers. So you end up having domestic wage income and foreign profit.
But don't you have more of everything? If it's foreign investment, I mean, that's extra money or it's extra capital which is flowing into the economy. So, I mean, land is a finite resource. But if we're talking about, for example, Amazon getting in or new companies investing, I mean, first of all, that's a sign of confidence that there's an opportunity to grow in that economy. But also, it's a capital inflow, isn't it? I mean, isn't that a good thing?
Well, here we go. You change the devil's advocate mode rather rapidly there, Matt.
I do it very well, don't I?
I know. But if we, my mouse just went flying. If we start with the early stages, if you have a country running a trade deficit and very early on 100% of its industry is locally owned and 0% foreign owned, and you then have to sell. Let's say you're running a 1% trade of GDP trade deficit, so you're forced to raise that amount of money in foreign currency, and you do it by selling. Let's say in this case selling land is one way of doing it. Let's say you're also accept foreign investment by a corporation like Amazon, and that 1% investment by them makes up for your trade deficit, and you have a level of economic performance similar to if you'd had a fully balanced trade situation. You might even gain if the scale of the investment is, again, hypothetical figures, but 2 or 3% of GDP rather than the 1% trade deficit you ran. So in that case, you do get a domestic stimulus. The question then is what happens over time as as that share of the ownership rises. What you have is a rising claim on the profit flows of the country going to the foreign corporations rather than going to the domestic corporations. Yeah. And then it's a question of just how profitable it is to invest in your country versus investing in another. And if it gets to the point where you have you are a dominant figure in a particular industry, Amazon's obviously a good case to choose there. Then once you get to the scale that's necessary to open up the entire market you've moved into, then in terms of their own company's calculations, it would be an unsuccessful investment if it didn't take out more than it put in its initial investment.
Right.
So,
but if it grows that sector, if it has created a more productive way of operating, and it's increased consumption for that sector, I mean, you could still have, a situation where everyone benefits. They could be taking more money out of it.
But what do you then have is a chronic lock-in of your trade, if your balance of payments deficit. As I was saying trade beforehand, it's really the current account, which is the balance of overall payments, including repatriation of profits. Now, if you get to the point where yes, it's helped grow your economy and so on, but then the proportion of your current account deficit, which is predominantly because of repatriation of profits, is of the order of 3 or 4% of GDP, then you've got permanent lock-in. It's no longer a case of if you just improve your productivity, you can turn that around. You have, if 40% of your local industry is actually foreign owned, and 40% of those profits are being repatriated all the time, and there's your lock-in for a current account deficit.
So it's a question of finding the balance, isn't it? Because I think the Amazon one is a great example, because those who are not familiar with Australia, Australian retail has been dominated, or certain sections of the Australian retail industry has been dominated by old school players like Harvey Norman that have just not innovated. And they are going to feel the hurt, and there is a lot of money going to be repatriated overseas as a result of it. But if it hadn't happened, Australian retail would continue to be in the dark ages. And, we're seeing very slow retail growth in Australia. I'm sure there is more money to be made in that sector if there's innovation.
And this is the important point, that what you're getting out of the foreigners can be that innovation that is not happening domestically.
Yeah.
Okay. And but of course, there's another way to go about that. This is one of my colleagues is a staunch believer that we should actually be selling blueprints to each other rather than selling products to each other. And you'd buy the Amazon blueprint, and then a local company would take that on rather than Amazon. So there'd be some need to pay a royalty fee, but not the profit repatriation. But that's in the hypothetical world.
Yeah, but I mean, you could also just say, I mean, you don't even need to do that. You could, I mean, if Australian retail was so keen to improve themselves, they could just say, well, let's take some good people from overseas who've done it overseas, which I think they've sort of half tried to do. But look, if the market's not moving, if there's no competition, you don't need to. You just say, well, why invest that money? Let's just do the things the way we've been doing them, because we don't face any challenges.
Yeah, and that's the positive side of the foreign investment coming in. I mean, another classic in that case was the IGA company when that moved into the Australian market again. So then you and I both saw the effects of. But certainly Amazon is a much larger technological move that means that an industry which has been complacent and basically charging large margins and suddenly forced to be very dramatically shaken up, and margins will fall. But at the same time, you then look, okay, where are the products coming from that are being sold in that market right now? And on that particular front with Amazon, I saw figures yesterday saying that something like 55 or 60% of the products are being sourced direct from China, whereas the common situation for Amazon's operations is that about 30% are sourced from China directly rather than from local suppliers, whether those local suppliers themselves indirectly buy from China and store on local warehouses and so on. So that's coming back again to the question of, are you being deindustrialized by doing this as well?
Yeah. But I mean, surely some form of direct investment where you're buying plant and machinery, I mean, it's still, take your point, but it is still a commitment to the economy, and that's surely a good thing versus the alternative, which is that foreigners are buying shares in Australian companies.
Yeah, I mean, I prefer the direct investment where you actually get the technology being transferred. And of course, what the classic instance of a country doing this extremely successfully was China, because I was back there in 81, 82 when they were building the Shenzhen Free Trade Zone. I actually went to it when the concrete still being laid, of all things, by an Australian company called CSR. And when we had the briefing on their proposals, why were they establishing the free trade zone, it wasn't just to get jobs for their workers, which is the usual motivation that applied in most of Southeast Asia, because this form of multinational relocation of production began back in the 1960s, really. So China was quite late to joining the party. They'd seen what had gone wrong in the rest of the world, and what had happened is foreign multinational would move in with its technology, establish local production. That might be like a local chip manufacturing site. Obviously, a lot of it was textiles as well. Let's stick with producing computer chips more cheaply. As the wages rose in the local area, they would then move to another country, and there'd be no benefit to the local capitalists from that initial investment, nor would they benefit, of course, when the company then pulled up stocks and went to another country where the wages were lower. So what the Chinese insisted upon was that any foreign investor had to have a domestic partner, and within 5 years, that domestic partner had to own 50% of the business. Now, because the wage differentials were so great in the 1980s, that was a good deal for American capitalists. Even though they were going to get half the profit stream out of what they created, it was still a dramatic increase in their profits relative to producing those goods back in America and paying higher American wages. So that was done in a very intelligent way by China. And what it's now meant, of course, China's running a huge trade surplus because it actually has ownership of a lot of those resources. And the huge motivation for the Chinese Communist Party came from many of them are engineers, and they wanted that technology as soon as possible. And that was a very deliberate reason for bringing those corporations in, as well as the financial aspects.
And it's curious, isn't it, how, we're in the West, we're very happy to see China or other countries buying in, even if it's money from the Chinese government. And that's the interesting thing as well, isn't it, when it's foreign investment by foreign governments. So a great example is Hinkley Point C, the new nuclear power plant for the UK, which is going to be paid for by French and Chinese money, and most of it is going to come from the governments of those countries. And that doesn't make a lot of sense, does it? I mean, why take foreign government money when we could just use our own government money?
The same thing for the foreign ownership of the rail system in the UK, which I still find quite stunning. I spent a lot of time comparing just how bad the British rail system is compared to what you find in the European continent. But at the same time, a lot of the European continent companies, government owned, are the ones who own large shares of the British rail system. So that comes down to just what are the encouragements for them to invest domestically. And when you have a government enabled captive transportation corridors to be developed in the belief that would give you private sector ownership, which are necessarily better than government. No, it's not, because you can basically just charge whatever you like for crap infrastructure and crap service on those lines, because nobody has any alternative line to go on. The whole idea of competition doesn't make any sense in that situation.
Yeah, still better than the Australian trains, mind you. I guess one of the big problems, though, is when the economy is down, when the chips are down. That is when you are most susceptible to this foreign investment, which, as you say, then makes the situation worse down the track, because all this money is being repatriated overseas. So no surprise, we saw a big increase in foreign direct investment in the UK in 2016. And I think probably we're going to find it's subsequent to that as well, because sterling became a bit of a bargain. So, I mean, the exchange rate has a big role in foreign investment.
Yeah, and that's sort of in some ways the other side of the advantage of a devaluation as well, because the devaluation makes your local manufacturers more competitive, if there are any, or it makes it a bit worth their while to consider repatriating, as long as the cost change is substantial enough. But at the same time, it also means those assets are a bargain for foreign buyers.
Yeah.
So you don't necessarily increase. It isn't just down to the question of the trade with different countries. It's how much of that is multinational owned.
So do we need controls then? I mean, do we need to actually say there needs to be some sort of stipulation on just how much foreign ownership there is in a developed country? I mean, poor countries are different. We'll look at those in just a second. But countries like the UK and Australia, do we need to put controls? I mean, there are sort of like national interest controls, but beyond that, should we be putting percentage figures, for example, as an absolute maximum?
I think we should certainly have a policy that actually bites on that front, because like this, again, in the Australian case, I think the Foreign Investment Review Board had over its enormous part of its lifetime had about 10,000 applications for foreign ownership, about one or two of which are challenged. So there's a trivial barrier these days, and it's largely because of the ideology, the sort of the neoliberal ideology that lies behind those policies. That's saying, well, anybody who wants to buy for a higher price than the locals do must necessarily be better for the local economy than the local buying it, and that mindset. Again, there's what's called the Pitchford hypothesis. I don't know if you've actually heard of that one. You're a lucky person, you're not a professional economist. But a guy called I think it's Pitchford, an Australian conventional economist, argued that, and this is where I find the problems with this form of thinking, said that if a country is running a trade deficit, that must, and therefore it's importing foreign capital, that must mean that foreign capital is being used with a rational eye towards future profits. So the deficits now will become surpluses sometime in the unspecified future. Now, that thesis was put forward, I think, about 25 or 30 years ago. And I don't know whether the person who made it, I think Pitchford is still alive, but he might never live to see the turnaround point that he's seeing, because the turnaround just doesn't happen. It's not a case of rational calculations about the future profitability, and therefore you import capital now to have a surplus in later years. It's just you're growing more slowly than the rest of the world through bad industrial policies, through low levels of investment, and low levels of technological development, and you don't necessarily increase that by handing over the ownership to foreign capitalists rather than domestic ones.
Well, I wonder whether, part of the thinking is a little bit outdated, because maybe if we look back to the industrial age, if foreign money built a factory in Melbourne and that factory employed, 15,000 people. That's 15,000 people earning money, paying taxes, buying stuff, and that could be good for the economy if the alternative was nobody built that factory and they were unemployed. But of course, the issue is they're probably investing in automation and not employing too many people, and so most of the money is just chuffing off back overseas.
Well, again, it's the income flow question, because this is the difficulty of trying to think about the global economy in terms of countries versus countries, when the corporations straddle those companies in quite complicated ways. So, I mean, the classic company in that sense would be Microsoft, which has develops its technology predominantly in America and India, and then has trade flows coming from all around the world, in particular in the UK case coming out of Ireland, where it has its offices for tax reasons. You start getting a corporate international trade structure, which is far stronger and far more flexible than the international trade between countries. And this is, to me, the main problem we face: a real weakening of the state system versus the corporate system. And so far, there's been very little sign that the nation state has any idea of how to cope with this, outside the case of countries like America, like Germany, like China, like Japan, Germany and China in particular, which have used this multinational structure to strengthen their own domestic economies. And the combination of both them being the foreign owners, so they're getting the repatriating profits from the rest of the world, and running a trade surplus as well, that's made them much, much stronger economies. And countries like the UK, like Australia, are suffering from a deindustrialization process because they simply don't have the local level of investment occurring. Yeah. And again, this is what Keynes was trying to stop back in the days of the Bank War, and the bloody Americans giving us the American dollar as the currency completely ruined that whole idea of a control mechanism on countries running large current account surpluses.
So how do we counter that? I mean, in a way, we're almost behaving like the poor countries with the multinationals, aren't we? I mean, let's look at that before we answer the question about how we fix the problem in the developed world. I mean, in poor countries, foreign investment's always been a bit of a question mark, hasn't it? Because if they don't pollute the environment or corrupt officials, then you could argue that, it's a good thing because it's money making its way into a country that might not otherwise, and there's some investment happening. But the other thing is, do they use up all the resources, take all the workers, repatriate all the profits out of the economy? But I mean, if you get the balance right, obviously it's good for those poor countries because it helps them to move up a notch.
And that's certainly what's happening with China's investments in Africa. So, but at the same time, I mean, that's another element of the nationalist element of China versus what happens with American corporations. They are predominantly quite frequently providing work for Chinese workers who are being, shipped with the country, with the companies to go and build these resources in foreign countries and own and operate. So you're getting only to the extent that foreign enclave buys local goods, do you have any real benefit for the local economy? But you do have this huge level of infrastructure being developed, which wouldn't have been there otherwise.
Right.
So, yeah.
But they're just chewing up resource. They're just claiming the resosources as their own, in effect. And particularly,
they're also creating them because they're laying the roads, they're laying telecommunications backbones, they're putting ports in. Of course, they end up having a fair hold of the international trade coming out of those countries, but they're providing an infrastructure that wouldn't be there otherwise. So it is a messy world, mate.
It is a messy world, isn't it? So how do we get the balance right then? So to take developed economies that have a big trade deficit like we do in the UK, what do we do about it? How do we stop it getting worse through foreign investment while having the benefit of having foreign companies helping to innovate?
I think, unfortunately, this is one of those cases where we have to, if we're ever going to get out of the problem, we have to have a move into the system we should have had back after the Second World War, which is the Bretton Woods system, as Keynes proposed it, with an international currency where you've got some capacity to control the extent to which current account deficits will accumulate and then weaken your country in its giving it a need for foreign capital, which means it ends up handing over ownership to foreign corporations rather than readjusting its exchange rate through the bank loan mechanism, which was Keynes's original idea.
Right.
And it's also...
So you think if you did that and you had so in effect exchange rates are being adjusted according to the relative trade deficits, and that's going to balance out the attractiveness of investing in various countries.
Yeah, and that was one of Keynes's not often remembered statements was to say, and above all else, let finance be national. Well, we've done a great job on that front, haven't we? And the extent to which we've allowed these trade imbalances, current account imbalances, repatriation of profit flows to become as enormous as they are, it isn't something we've managed particularly well.
So finally, then. Let me give you what the Australian Department of Foreign Affairs and Trade on their website list as the benefits of foreign investment. You tell me, there's only 3 of them. For each of them, you tell me whether there's anything in it at all, or is it all just pure bunkum. Number 1, it helps Australia reach its economic potential by providing capital to finance new industries and enhance existing industries, boosting infrastructure, productivity and employment opportunities in the process. Hallelujah.
Yeah, again, is this a question of your domestic money production systems, in fact, fundamentally the banking system not providing finance for firms to invest, the government trying to run a surplus when it shouldn't be trying to do that, starving you with those funds you'd have otherwise. And when you bring in the money internationally, what you're effectively doing is making up for your poor capacity or poor performance in producing your own domestic money supply. So I don't think that one particularly counts. The only time it counts is when you use that foreign money to buy technology that doesn't exist domestically.
Right. Okay. So in other words, we should be doing it ourselves. The bank should be pulling their finger out and lending the money in a productive way. The second one, the higher growth supported by foreign investment pays dividends for all Australians by increasing tax revenues to federal and state government.
That almost deserves a laugh, doesn't it?
I was going to say, it doesn't actually explain how that works.
No, because so long as they don't establish operations in the Cayman Islands, oh dear, they do. I mean, that's one of the problems, and this is one of the reasons we have such a conflictual society these days, the extent to which corporations have managed to evade the taxes we're trying to place on them, and the best placed companies do that are the foreign-owned ones. They've already got the structures in place.
All right, then the final one. By bringing in new businesses with connections in different markets, it opens up additional export opportunities, boosting our overall export performance. It also encourages competition and increased innovation by bringing new technologies and services to the Australian market. So I guess this is the innovation one that we're talking about.
The latter point is one we were actually agreeing with earlier on. It is also possible to say, well, you've got these channels that come out of the foreign corporations working domestically. Maybe, therefore, a domestic company can piggyback onto the foreigners. And I knew some people work in the audio industry who saw some potential for them to be able to piggyback their technology on when foreign companies like AR and so on turned up in the country producing high-end stereo equipment. They saw a way that they could actually get their technology piggyback back onto the rest of AR's distribution system in the rest of the world. So it does happen. So I think 1 out of 3 ain't bad for the Australian Department of Foreign Affairs.
No, it's not bad, is it? So the real answer, though, so a neutral international currency where we can manage the difference in the terms of trade. Given that that's not going to happen in a hurry, I mean, is the other alternative in the short term that we just treat it with a bit more seriousness and look harder at those foreign investment opportunities and just should be asking, can we do this ourselves? Do we need it?
Yeah, and I think surely one of the major issues we face globally has been these current account imbalances. Unless we start saying, well, they're actually a serious topic, we need to reduce them, they're not going to fall of their own volition. Then that's, I think, the perspective I'd like to take on looking at foreign ownership in future.
Right. But that point is hardly ever raised. No one seems particularly concerned about balance of trade.
Well, that comes down to when you're concerned about it, you become you're on the periphery. A figure like John Mills, who's been arguing this case in the UK now for 20 or 30 years, that by having an overvalued exchange rate, which is his main explanation for the situation, you end up destroying your own industry. And I think that is one of the related elements that's quite correct about this case. If you let the current account deficit get as extreme as it's got and sustained for as long as it does, then ultimately you, particularly in a world where people are trying to run government surpluses all the time, you end up having a depressed level of economic growth in your own country, and you end up paying for it rather than benefiting from it.
All right, good point to leave it on. We'll catch you again soon, Steve. Thank you.
Okay.
Well, next time, another topic that relates very much to now, corporate tax. Donald Trump is trying to get his corporate tax rates down so that the same level as many other competing countries like the UK, for example. And so long as countries like Ireland will run low corporate taxes to become a safe haven for major corporations trying to reduce their liabilities, does it actually make sense to have a corporate tax at all? What would happen if you just got rid of it? You might be surprised, in fact, what a small slice of the total revenue pie it accounts for. So that's next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. We'll see you then. Thanks for listening.